On June 12, 2026, SpaceX went public. It was the largest IPO in the history of financial markets, more than triple the size of the previous record holder. And by the end of its first day of trading, the company was worth over $2 trillion, bigger than Tesla, bigger than most entire national stock markets. Within days, financial media had moved on to the next headline, because world's biggest company IPOs, stock pops, is a story with a beginning, a middle, and an end. Except that's not actually where this story ends. Because 3 weeks before SpaceX even rang the opening bell, the rules of the game had already been quietly rewritten to guarantee a specific outcome. And almost nobody noticed, because it didn't happen on the trading floor. It happened inside an index methodology document that maybe 400 people on Earth actually read. So let's start with what SpaceX actually is, because most people have the wrong picture in their head. Say SpaceX and people picture rockets, reusable boosters, Mars missions, astronauts. That's the brand. But by revenue, that's not even close to the real business anymore. SpaceX today is really 3 companies stitched together. There's the rocket and launch business, government contracts, NASA cargo runs, commercial satellite launches, which is the original business and the one with the name recognition, but it's a smaller slice of revenue than most people assume. Then there's Starlink, the satellite internet arm, which has quietly become the actual engine of the company. And more recently, there's xAI, the AI lab Musk folded into SpaceX through an all-stock combination that valued the AI business in the hundreds of billions of dollars, despite it generating a tiny fraction of the revenue of its AI competitors and having burned through cash and personnel at a pace that's hard to overstate. Here's the part that should stop you. Starlink alone brought in roughly $11.4 billion in revenue in 2025, up sharply from the year before, and now accounts for roughly 61% of SpaceX's total revenue. Over 10 million people in more than 150 countries are paying a monthly bill to get internet beamed down from a satellite constellation. That's not a moonshot side project anymore. That's the actual company. The rockets are almost the marketing department at this point. So if Starlink is the profitable engine, and the rockets are respectable but unspectacular, why is the combined entity worth close to $2 trillion, more than legacy industrial giants, more than most G20 countries' entire stock exchanges combined? Part of the answer is genuine enthusiasm for Starlink's growth trajectory, but a bigger part of the answer has almost nothing to do with rockets, satellites, or artificial intelligence. It has to do with a rule change at Nasdaq that most investors have never heard of, and it's worth slowing down on because this is the actual story. For decades, if a company wanted to join the Nasdaq 100, the index that includes household names like Apple, Microsoft, and Nvidia, it had to sit out a seasoning period of roughly 3 months after going public before it was even eligible to be considered. That waiting period existed for a simple reason. It let the market figure out what the stock was actually worth before hundreds of billions of dollars in index tracking funds were forced to buy it automatically, no questions asked. It was a speed bump, and it was there on purpose. In March of 2026, Nasdaq proposed scrapping that speed bump for the biggest new listings. The rule, officially adopted and effective May 1, 2026, is called fast entry. Under the new methodology, a newly listed company can be evaluated for index inclusion after just 7 trading days, and if it ranks in the top 40 of existing Nasdaq 100 constituents by market cap, it can be added to the index in roughly 15 trading days. 3 months of price discovery compressed into 3 weeks. That alone would be a meaningful change, but there were 2 more pieces buried in the same rule package that matter even more. The old rules required a company to have at least 10% of its shares actually floating and available for public trading before it could join the index at all. That requirement is gone entirely, and in its place, Nasdaq introduced a weighting formula. For any company with a float under roughly a third of its total shares, the index treats that float as 3 times larger than it actually is when calculating the company's weighting up to a cap. SpaceX went public with a float in the single digits, a small sliver of total shares actually available to trade, with the rest still held by Musk, early investors, and employees. Under the old rules, that low a float likely would have kept SpaceX out of the index altogether for a long stretch. Under the new rules, it doesn't just qualify, its influence on the index gets synthetically amplified. Let's make this concrete. Picture Maria. Maria has a completely ordinary retirement account, a target date fund inside her 401k that happens to track a Nasdaq 100 index fund, because that's the kind of low-fee, diversified, set-it-and-forget-it fund most retirement plans default people into. Maria has never heard of SpaceX's IPO. She's never made a single trade. She has no idea what a free float weighting adjustment is. But because her fund is mechanically required to hold every stock in the index in proportion to its official weighting, when SpaceX gets fast-tracked into the Nasdaq 100, her fund manager doesn't get a choice. The fund has to sell slices of Apple, Microsoft, Nvidia, and every other current constituent and use that money to buy SpaceX automatically, without Maria's input, without Maria's knowledge. That's the mechanism. And it's not a small mechanism. Index tracking products built around the Nasdaq 100 hold hundreds of billions of dollars in assets. Even a modest weighting for a new constituent translates into billions of dollars of guaranteed price-insensitive buying. Buying that has nothing to do with anyone's judgment about whether SpaceX is a good investment at a $2 trillion valuation, and everything to do with a formula in a rulebook. Here's the detail that makes this less about SpaceX specifically and more about a pattern. SpaceX wasn't a one-off. Nasdaq built this rule while fully aware that OpenAI and Anthropic were also expected to pursue enormous IPOs around the same window, and both have since taken steps toward exactly that. This wasn't a rule tailored to one company's paperwork. It was infrastructure built in advance for a category of company, the kind that stays private for as long as possible, grows to a jaw-dropping valuation before ever selling a single share to the public, and then lists with a tiny float because the founders and early investors have no interest in giving up control. Most IPOs set aside somewhere around 5% to 10% of shares for everyday retail investors, with a bulk going to institutional buyers who theoretically do the diligence. SpaceX's IPO structure allocated a dramatically larger share to retail, reportedly in the range of 30%, roughly 3 to 6 times the typical amount. On paper, that sounds like democratization. Regular people finally get access to a company they could never have bought into as a private stock. In practice, it means a much larger share of the world's largest ever IPO landed directly in the hands of investors who had the least ability to independently value a $2 trillion company with a business built partly on an AI subsidiary that had just lost its entire founding team and was burning enormous sums of cash every month. So, here's the actual sequence laid out plainly. The people who built and funded SpaceX over the past 2 decades, the ones with the lowest cost basis, the ones who bought in when the company was worth a fraction of its IPO price, get first access to liquidity. Then a fast-tracked index rule guarantees that passive funds, the ones sitting quietly inside hundreds of millions of ordinary retirement accounts, become mandatory buyers within weeks, regardless of price. And a historically oversized retail allocation puts a huge chunk of the remaining shares directly into the hands of individual investors buying near the top, based on brand loyalty and hype rather than the fundamentals of a company that, as a combined entity, including its AR arm, has been posting significant net losses even as its rocket and satellite businesses turn a profit. The buyers show up early and mechanically. The people with the ability to sell show up whenever they choose. That mismatch is the entire story, and it's a story that has nothing to do with how good Starlink's technology is. This is also worth pausing on. This isn't really a story about whether Elon Musk is a genius or a fraud, and it's not about whether Starlink is a legitimately great product. By most measures, it is. It's a story about market structure, about the fact that the mechanism which makes passive investing cheap and simple for tens of millions of Americans, the fact that your index fund just quietly buys the market for you, is the exact same mechanism that makes you a guaranteed automatic buyer of whatever gets engineered into that index on a timeline built to benefit whoever's doing the engineering. Nobody asked Maria if she wanted exposure to a barely profitable AI subsidiary bolted onto a satellite internet company. Her fund bought it for her anyway, because the rulebook said to. And that's really the pattern worth watching going forward, because SpaceX won't be the last mega cap to go public this way. If OpenAI or Anthropic follow a similar path, staying private until their valuations are almost incomprehensible, then listing with a small float and a large retail tranche, the same mechanical buying will kick in again, and again it will happen quietly, buried in a methodology PDF instead of a headline.
The next time you see biggest IPO in history trending, it's worth asking, who exactly is doing the buying, and did they actually get a choice in the matter? Because increasingly, in modern markets, the answer to that second question is no. The choice was made for them months earlier by a rule they never read that was written specifically so they wouldn't have to be asked.